You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Welcome to the Deep Dive. Today, we're jumping into a listener request, and it's definitely something on a lot of people's minds. How to actually build passive income streams in, well, the year ahead, 2025.
Yeah, it's a really smart focus right now. I mean, just look at the situation. We've still got these questions about interest rates hanging around. Inflation hasn't totally gone away.
Right.
You've got AI just accelerating and changing whole industries, plus, a new administration potentially shifting policies.
It feels uncertain.
Exactly. Relying only on your job, that active income, it just feels a bit risky for a lot of folks now. So passive income, it's not just nice to have, it's becoming pretty essential for financial resilience.
Totally agree. And our job today, digging into these sources you brought, is to really unpack what they're calling this passive income trifecta for 2025. That's dividend-focused ETFs, real estate investment trusts, REITs, and then this category they've labeled modern alternative investments.
Yeah, and each one offers a pretty different way to generate income without needing, constant hands-on effort.
Yeah.
We'll look at why the sources are pointing to them now and how you might think about fitting them into your own wealth-building plan.
Okay, but first, a really quick, important point. When we talk about passive income, we don't mean like zero work ever, right? Setting this stuff up takes research. You have to make those initial investment choices.
Sure, there's upfront work.
And you need to monitor things, maybe rebalance sometime. The real goal is income that comes in with, let's say, minimal day-to-day fuss once you've laid the groundwork.
Right, it's less set it and forget it and more like set it up smart so it works for you.
Exactly. So let's crack open these sources and see what makes these three stand out for income potential in 2025. Okay, let's dig into that first pillar. Dividend-focused ETFs, exchange-traded funds. Now, dividends aren't new, obviously, but why are these ETFs getting special attention now, according to the sources?
Well, the most striking thing, honestly, is how they've been performing lately. There's Morningstar data showing dividend strategies really outpacing the broader U.S. market early this year.
Oh, really?
Yeah, through March 2025, the main U.S. market index was actually down over 4%, but Morningstar's dividend yield focus index, it was up over 6%.
Wow, okay, that's a 10-point swing in just 3 months. That definitely gets your attention.
It does. And the sources stress, it's not just about chasing yield numbers. It kind of speaks to the quality of the companies inside these ETFs.
Quality, how so?
Well, typically, these are businesses with really solid cash flows. They're established. They have a history of actually paying and growing their dividends, even when the economy gets choppy.
Okay, that makes sense. And the sources give a few reasons why these might be well-suited for 2025 specifically. One is the interest rate situation, kind of a Goldilocks thing, maybe. Rates are high enough to keep companies disciplined, not spending wastefully, but maybe not so high, especially if they ease up later, like some expect, that they completely crush operations or force dividend cuts.
That's a good point. And another factor is valuation. After the last couple of years where growth stocks, especially big tech, just went on a tear.
Right.
A lot of these steady dividend payers look, cheaper now. Relative to their earnings, their cash flow, you might be getting that quality at a better price, plus the income.
And there's the inflation angle, too. The sources point out that companies consistently growing dividends often have pricing power.
Meaning they can pass costs on.
Exactly. Pass higher cost to customers, protect their margins, and keep boosting those payouts. So it acts as a kind of inflation buffer, potentially.
So why the focus on ETFs specifically rather than just picking individual dividend stocks?
For most people, it boils down to easy diversification and managing risk. With an ETF, boom, you instantly own a piece of dozens, maybe over 100 companies. So if one company hits a rough patch and cuts its dividend, we saw some of that during the pandemic, remember? Your total income from the ETF is much more stable because it's spread out.
Plus, the research headache is way lower. You've got professional managers doing the analysis and monitoring for you.
And for a pretty low fee, usually. The sources mention often under 0.2% per year for the good ones.
That's cheap.
They highlight one specific example, the Schwab U.S. Dividend Equity ETF, ticker SCHD, yields around 4% currently. But the real value, they argue, is its method.
How it picks stocks.
Yeah. It doesn't just grab the highest yielders. It screens for dividend sustainability using things like cash flow strength, return on equity, the current yield, and importantly, a 5-year history of dividend growth, trying to avoid those yield traps.
The yield trap, where a super high yield is actually a warning sign of a coming cut.
Exactly.
And it's good to remember there are different kinds of dividend ETFs too, right? Different flavors.
For sure. You can go for a high current income, focusing on funds yielding maybe 4%, 5%, 6%. But the trade-off might be slower growth, maybe a bit more volatility.
Or you can go the other way, focus on dividend growth.
Right. Those ETFs look for companies with really long track records of raising dividends every single year. Like the Vanguard Dividend Appreciation ETF requires, I think, 10 straight years of increases.
The yield will be lower there, though.
Oh, yeah, much lower, maybe 1.5% to 2%. But historically, the growth in that dividend payout has been strong, like 7-10% a year, compounding over time.
And don't forget international options for diversification. Given the strong dollar lately, you might find some value overseas.
True, but you add currency risk, political risk sometimes.
Fair point. And taxes matter too.
Definitely. Good news is most dividends from U.S. companies are qualified, so they get taxed at those lower capital gains rates.
Which is better than regular income tax rates.
Much better, but you still owe tax on them each year if they're in a normal brokerage account.
Which is why tax-advantaged accounts are often the best place for them.
Exactly. Think IRAs, 401k. Let that income compound year after year without the tax drag.
So, bottom line for you listening, thinking about dividend ETFs in 2025.
It's that combination. Decent current income, the potential for that income to grow, and a bit of defensiveness in this uncertain market. Yields can range quite a bit, 1.5% up to 5% or more.
The key takeaway from the sources seems to be focus on sustainable strategies, keep costs low, look at the track record, don't just chase the highest yield number you see.
All right, let's pivot to pillar number 2, real estate investment trusts, REITs. Now, these aren't new either. They've been around for ages, letting people invest in real estate without being a landlord. But the sources seem pretty positive on them for 2025.
Yeah, and again, look at the recent performance. Through Q1 2025, the main REIT index actually gained almost 3%.
While the overall market was down.
Exactly. Broader stock market down nearly 5%, Russell 1000 down 4.5%. So REITs showed relative strength and almost 8-point outperformance early in the year.
And here's something the sources really hammered home. REITs are apparently still trading at pretty significant discounts compared to the actual value of the properties they own if you try to buy them privately.
So you're saying you can buy the REIT shares for less than the buildings themselves are worth?
Kind of, yeah. You're buying into this professionally managed portfolio of properties, potentially for, cents on the dollar compared to their private market valuation.
Okay, that's interesting. So beyond that value angle, what makes them attractive for passive income specifically in 2025?
Well, part of it is that interest rate story again. Rates going up hit REITs hard initially, we know that. But the sources suggest the sector's adjusted pretty well. They've managed their debt.
And if the Fed does cut rates later this year, like many expect,
that could be a nice tailwind. Could boost property values, make financing cheaper for growth.
Another big factor mentioned is supply and demand, right?
Huge factor. New construction costs are up, financing is tougher, so building new properties has slowed way down in a lot of areas.
Which benefits the owners of existing buildings.
Exactly. It creates this favorable supply situation for REITs that already own good properties. They can push rents higher, keep occupancy strong.
The sources mention industrial REITs as a prime example.
Yeah, the warehouse and distribution center guys. Massive demand from e-commerce, from companies bringing supply chains back onshore.
Reshoring, yeah.
But building giant new warehouses is slow and expensive right now. So the existing ones, they're golden. Long leases, often with rent increases built right in. That means predictable, growing cash flow for the REIT shareholders.
And REITs have that unique legal structure advantage, too.
Oh, right, the 90% rule. By law, they have to pay out at least 90% of their taxable income as dividends to shareholders.
It's not optional like for a regular company.
Nope, it's baked into their structure to maintain that REIT status. Their whole business model is basically designed to generate income and pass it through to investors.
And the types of properties REITs own now is incredibly diverse. It's not just shopping malls anymore.
Not at all. The sources get really specific about sectors with strong momentum for 2025. Data centers are a huge one.
Driven by AI.
Absolutely. All that computing power needs a physical home. Data center REITs own these specialized buildings. Demand growth is projected at 10-15% a year. And it's tough to build new ones, need massive power, specific locations, specialized infrastructure.
High barriers to entry. Names like Digital Realty, Equinix are in that space.
Then there's healthcare REITs, just undeniable demographic tailwinds there.
The aging population.
Yep, aging boomers. Over 73 million Americans, over 65 projected by 2030. That means steady demand for medical offices, hospitals, senior living facilities. These are pretty stable properties, too, usually essential services.
We already talked about industrial REITs and e-commerce.
Right, long leases, stable income. And residential REITs, too, especially apartments.
Because buying a house is so expensive.
Exactly. High home prices, high mortgage rates push people into renting. And just like other sectors, new apartment construction has slowed, creating that supply-demand imbalance that lets landlords raise rents.
Okay, so for you listening, how do you actually invest in this?
Well, you could buy individual REIT stocks. That gives you control, but requires more research on specific companies, specific sectors.
Or for easier diversification, probably REIT ETFs or mutual funds.
Yeah, that's often the simpler path for passive income. You can get broad exposure with something like the Vanguard Real Estate ETF, or even drill down with sector-specific ETFs if you really like the story for, say, data centers or healthcare REITs.
What are the main risks to keep in mind?
Interest rate sensitivity is the big one historically. When rates rise, REIT prices can suffer, though it's complicated, depends on why rates are rising.
And sector risk is key now, too. Owning an office REIT is very different from owning a data center REIT today.
Totally. So diversification within your REIT holdings is important. Don't just bet on one property type.
But the income potential is definitely there. Average REIT yields around 4%, roughly triple the S&P 500.
Some yield even higher, 6% plus, but usually that comes with more risk, right?
Always a trade-off. And many REITs aim to grow those dividends over time as rents go up.
So the core idea for you on REITs in 2025, attractive yields right now, potential for income growth, that inflation protection from owning real assets, and you get access to these big trends like data centers or healthcare without buying the buildings yourself.
Just needs careful selection and diversification like anything else.
Okay, on to our third category, this modern alternative investments bucket. It sounds a bit vague, but I think the modern part is key, right? Technology making these things accessible.
Exactly. We're talking about assets that go beyond your standard stocks, bonds, or even those publicly traded REITs we just discussed. The modern angle is that tech platforms are now letting regular investors get into asset classes that used to be just for big institutions or the super rich.
And often with the goal of passive income. So what kind of things are we talking about?
Well, one area the sources highlight is cryptocurrency staking. Now, crypto itself is famously volatile.
Understatement.
But staking is a way to potentially earn income from certain cryptos you hold long term.
How does that work again?
Basically, you lock up your coins to help run the network, validate transactions, keep things secure. And for doing that, you earn rewards, usually paid out in that same crypto.
So it's kind of like earning interest.
Sort of, yeah. But the potential yields can be much higher. The sources mentioned ranges like 4% up to maybe 15% annually. Depends heavily on the specific crypto network. Ethereum's around 3-4% right now. Solana maybe 6-8%.
And is it actually passive?
After you set it up, yeah, pretty much. You're not trading day to day. You're just earning rewards for holding and supporting the network. And lots of exchanges and platforms now offer staking as a service, handling the technical bits for you.
Okay, but the risks must be high too.
Oh, absolutely. Huge price volatility is the main one. The value of what you've staked can plummet. And there's something called slashing risk. You could actually lose some of your staked coins if the network validators you delegate to mess up or go offline.
So for you thinking about this, crypto staking sounds like maybe a small speculative slice of a portfolio.
Definitely. Like 2-5% max, the sources suggest. And only with money you can truly afford to lose. It's really for people already bullish on crypto long term who want to earn something while they hold.
Got
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
it. What else falls under this modern alternatives umbrella?
Peer-to-peer lending, or P2P, is another one. These are online platforms connecting borrowers directly with lenders, cutting out the banks.
Right, lending to individuals or small businesses.
Yeah. And these platforms have gotten pretty sophisticated. Better algorithms for assessing risk, tools to automatically spread your money across tons of tiny loans.
Diversification.
Exactly. Reduces the impact if one borrower defaults. And they handle all the payment collection.
What kind of returns are possible there?
Sources cite typically 4% to 12%, depending on the risk level of the loans you choose. Potentially quite a bit better than a savings account or CD right now, and you can often set it to auto-invest, making it fairly passive.
Risks being?
Credit risk is the big one. Borrowers might just not pay back the loan. And liquidity risk, it's usually hard or impossible to get your money out before the loan term is up.
Okay. The sources also mentioned investing in like future revenues or royalties.
Yeah, that's an interesting area. On the business side, you might provide capital to a small company and get a percentage of their future sales back until you hit a target return.
So your return is tied to their success.
Directly to their sales, yeah. Can be simpler than trying to figure out what the whole company is worth. On the other side, there's intellectual property royalties.
Like music.
Music is a big one. Platforms like Royalty Exchange let you buy a share of the future royalties from songs, maybe film rights, patents. If the content stays popular, it can be a steady income stream. Music royalties often yield in the 6–12% range, according to the sources.
Main risk there is the song or movie just fades in popularity, I guess.
Pretty much, the value of the future income stream drops.
Then there are these fractional real estate platforms. How are they different from REITs?
Good question. REITs typically own huge portfolios, often across many properties. Fractional platforms like Fundrise, Yield Street, Arrived Homes let you invest smaller amounts, sometimes just $10 or $100, into specific individual properties or development projects.
So you know exactly which building you're investing in.
Often, yeah. They tend to be more transparent about the specific asset. You might see photos, metrics, maybe even virtual tours. Income comes from rent collected and hopefully appreciation. Yields are often in that 4–8% range.
Downsides compared to REITs?
Liquidity is usually much lower. Selling your share before the project finishes can be difficult or impossible. And there's platform risk. What happens if the company running the platform goes under?
Right. And finally, fractional art and collectibles, like buying a tiny piece of a Picasso.
Sort of, yeah. Platforms like Masterworks do this for fine art. You buy shares in multi-million-dollar paintings.
What's the appeal there for passive income?
It's usually less about regular income distributions and more about potential long-term appreciation when the artwork is eventually sold. So maybe growth aiming for eventual income. The appeal is diversification, historically low correlation to stocks, maybe an inflation hedge.
But super illiquid, I imagine, and risky.
Very illiquid, volatile, valuations are subjective. No guarantee it appreciates or sells well later.
So putting this whole alternatives category together, what's the general advice from the sources?
Treat them as supplements, not replacements, for your core holdings like stocks, bonds, REITs. Maybe allocate 10–20% of your portfolio max to these combined.
And only money you can afford to potentially lose.
Given the higher risks, yes. Start small, maybe $500 or $1,000 in one or two areas that interest you, just to learn how they work, and be fully prepared for much less liquidity than you get with stocks or ETFs.
Okay, so the core insight for you on alternatives in 2025, potential for higher yields, potential for diversification, but definitely comes with more complexity, higher risks, requires homework and knowing your limits. Okay, so we've covered dividend ETFs, REITs, and this diverse world of modern alternatives. How does someone actually start weaving these together into a coherent passive income strategy for 2025?
Well, the absolute most important principle that comes through in the sources is diversification. But not just owning lots of different companies. It's about diversifying across different types of income sources.
Because they react differently.
Exactly. Dividend stocks, real estate rents, P2P loan interest, crypto staking rewards. They all behave differently depending on what the economy is doing.
So the sources suggest kind of layering them.
Yeah, that's a good way to think about it. Maybe build your foundation with dividend ETFs, say 40–50% of the money you're allocating to passive income. They offer that blend of stability and growing income, generally lower risk.
And you could mix different types, like high yield and dividend growth.
Right. Get some income now, position for income growth later. Then add a layer of REITs, maybe 30–40% of the allocation. That gives you the real estate exposure, the inflation hedge potential.
A broad REIT index fund maybe, plus a specific sector fund if you like a particular story.
Could make sense, like a core REIT ETF plus a smaller position in a data center or healthcare REIT ETF if you have conviction there.
And then finally, that smaller slice, 10–20%, for exploring alternatives.
Yeah, that's where you really match it to your own risk tolerance and what interests you. Comfortable with crypto? Maybe a tiny staking allocation? Prefer lending? Look into P2P. Intrigued by specific properties, fractional real estate.
And when we think about risk management for passive income, it's not just about avoiding losing money, right? It's about the income being reliable.
Precisely. You need to avoid concentration risk.
Yeah.
Don't just pile into the highest yielding thing you find. Remember, super high yield often signals super high risk of that income getting cut.
Need to think about correlation, too. Do all your income sources tend to drop at the same time when things get scary?
Good point. True diversification means having income streams that hold up, or at least behave differently under stress.
And liquidity. Don't lock everything up.
Absolutely.
Right.
Keep that emergency fund separate and easily accessible. Have some assets you can sell relatively easily if needed, outside of those less liquid alternatives.
Taxes are huge here, too. They directly eat into your actual spendable passive income.
Yeah. Cannot stress that enough. Use those tax-advantaged accounts, IRAs, 401k, HSAs, if applicable, as much as you can for things like dividend ETFs and REITs. Let that income grow and compound tax-free or tax-deferred.
And be smart about what goes in your regular taxable brokerage account.
Yeah, REIT income is often taxed as ordinary income, which can be less efficient than qualified dividends from stocks. So maybe prioritize qualified dividend ETFs there. Understand the tax treatment.
And some of those alternatives might throw a wrench in things.
Could do. Some P2P platforms or fractional investments might issue K-1 tax forms instead of the usual 1099s. Those can make tax filing more complicated, so just be aware of that potential headache. Might need a tax pro.
So for you listening, maybe feeling a bit overwhelmed, how do you actually start?
The sources say, start simple. Don't try to do everything at once.
Like month one.
Month one. Open a low-cost brokerage account if you don't have one. Pick one broad, low-fee dividend ETF and one broad REIT ETF. Maybe set up automatic monthly investments, even small amounts, to get started with dollar cost averaging.
Keep it simple.
Then, over the next few months, say months 2 through 6, do a bit more learning. If you read up on data centers or healthcare demographics and feel good about those trends, maybe add a small position in a relevant sector ETF.
And alternatives come later.
Much later, maybe after 6 months or more, once you've got that foundation built. Then you could explore one alternative category with a small amount, $500 or $1,000, just to dip your toe in and see how it feels.
And this isn't a set it and forget it thing, even with ETFs.
Right.
Monitoring is needed.
Right. Check in periodically, maybe quarterly. Look at the income being generated. Is it meeting your expectations? Is the strategy working?
And be prepared to adjust.
Yeah, things change. Markets shift. Tax laws might change. Your own life situation changes. You might need to tweak your allocations. But don't just react to headlines or chase whatever did well last year. Stick to your plan. Make thoughtful changes based on research.
Okay, as we wrap up this deep dive on building passive income for 2025, I think the big takeaway is remembering this is a long game.
Absolutely. Building passive income streams that can really make a difference to your financial freedom. That takes time. It takes consistent effort. It takes patience. It's definitely a marathon, not a sprint.
But hopefully we've shown, based on these sources, that there's a path. Combining dividend ETFs, REITs, and maybe some carefully chosen alternatives can create a pretty robust, diversified income portfolio over time.
And the most important thing really is finding a strategy that you understand, that makes sense for you, and that you can actually stick with, through good times and bad.
And you don't need a fortune to start. That's key too. Lots of these ETFs and even some alternatives have super low minimums now. Just getting started is often the hardest but most important step.
Keep learning. Stay curious. The financial world never stands still.
And just our standard reminder, this conversation was for educational and informational purposes only. It's definitely not investment advice. Please do your own research and consider talking with a qualified financial professional before making any investment decisions.
If you found this deep dive helpful, we'd love it if you'd subscribe, maybe leave a review, or share it with someone else who's thinking about their own passive income journey.
Next time on The Deep Dive, we're going to tackle tax loss harvesting, what it is, and how it might help you lower your investment tax bill.
Until then, keep building, stay informed.
And remember, your financial future really is in your hands. Understanding these tools is just the first step. So, what part of your passive income strategy will you explore next?
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.